In our previous video, we discussed the basics of trading currency pairs. Today, we'll see their categorization. Currency pairs are split into three main categories, and those would be the majors, the minors, and the exotics. The major currency pairs have the US dollar on the one side, either left or right, as the US dollar is considered as the world's reserve currency since the US and its allies agreed at the 1944 Bretton Woods conference to peg it to a rate of $35 per ounce of gold. Despite the agreement being superseded by the free market system, the US dollar is still considered the global reserve currency. The major currency pairs are the most frequently traded pairs in the world, and they constitute the largest share of the foreign exchange market. Examples of major currency pairs could include the euro against the US dollar against the yen, the pound against the US dollar against the Swiss franc, the US dollar against the Canadian dollar, or even the Australian dollar against the US dollar. The second currency category is the cross-currency pairs, or if you prefer, the minor currency pairs. These are currency pairs that do not include, let me repeat that, do not include the US dollar, and are also called cross rates or crosses. They are also known as minors, and the most actively traded are derived from the three major non-USD currencies, and these would be the euro, the JPY, and the pound. Examples would be the euro against the pound against JPY, or the euro even against the CAD. The third currency pair category is the exotic currency pairs. These currency pairs are made up of one major currency paired with a currency of an emerging economy, or a small economy from a global perspective, such as Hong Kong or Singapore, and several European countries outside of the Eurozone. Such pairs could include, for example, the US dollar against the South African rand, or the US dollar against the Turkish lira, or the euro against the Czech krona. It should be noted that although exotic currency pairs may provide higher profits, their volatile and sometimes unpredictable nature may prove a drawback for such trades. Also, the low liquidity and higher spreads are other issues which traders of such pairs may have to face. In the next video, we'll be discussing the evolution of the FX market.